To scale a financial agency today, you are generating a high-velocity stream of inbound leads and crashing directly into a wall of regulatory constraints. Take an agency attempting to absorb a pending 1,400 policy acquisition. Adding nearly 1,000 new people to the book of business requires doubling existing performance targets to remain sustainable. The standard industry response to this kind of volume is to open the floodgates of automation, deploying AI workflows and algorithmic outreach to process the influx at speed. However, in highly regulated sectors, parent companies mandate strict data security protocols. You cannot simply feed a massive book of business into an open AI platform without violating compliance. To process this volume without triggering a breach, the agency is forced to separate its operations, using high-speed tools for the noise while maintaining a secure, human-led environment for the actual client data. This separation starts with the hardest constraints. First, there are absolute bans on putting personally identifiable information, or PII, into third-party AI systems. Client data simply cannot touch external algorithms. Then there are the restrictions on communication. Without explicit prior consent, agencies are often barred from texting a lead after just a single response, which forces the team back onto manual phone calls. These rules are rarely synchronized. Lead providers, state regulators, and parent companies each issue conflicting mandates on what constitutes a compliant interaction, creating a maze of operational rules. Bypassing these rules is not an option. A single breach can lead to lost vendor access and the collapse of the agency's operational stability. This map shows how the agency processes a 1,400 policy influx. We start with a high-volume top-of-funnel, fed by live transfers and marketplace inputs. Routing this raw volume directly to internal staff creates an immediate bottleneck. The friction of cold outreach leads to rapid burnout. An internal team tasked with processing infinite raw volume eventually overheats. The pressure of constant low conversion calls destroys their capacity to handle actual client advisory. The solution is a dedicated filter layer of offshore telemarketer support and AI-driven appointment setters at the front of the pipeline. This layer absorbs the noise. It authenticates initial conversations, managing high-volume contact without touching sensitive client data. By filtering the raw volume through these external systems, the agency ensures that only qualified prospects who have provided explicit consent ever reach the core team. Once a lead is authenticated, it moves toward the critical threshold separating the external filters from the internal agency systems. This is the compliance firewall, a strict boundary stopping automated tools. AI operates strictly on the exterior, handling logic and trapping without touching the internal database. PII bypasses the AI entirely, crossing the firewall through secure, encrypted channels. This physical air gap satisfies the parent company's security mandates, ensuring that mandatory device software remains isolated from unauthorized third-party integrations. The compliance firewall is the essential architecture that allows an agency to use AI legally while managing high-volume growth. Once clean, authenticated data safely clears the firewall, it populates the internal CRM. Here, the CRM automatically scans the records to identify specific cross-selling opportunities, flagging individual accounts for follow-up. These automated alerts target refinance eligibility and home equity levels, valuable data points in a volatile mortgage market. The primary beneficiaries of this internal data routing are the loan officer assistants, or LOAs. Equipping the LOA team with these targeted triggers removes the friction of manual data mining. The system provides them with ready-to-execute intelligence for routing applications and managing client files. Automation inside the firewall is focused entirely on routing intelligence to support staff, rather than replacing direct client communication. By offloading the friction of cold prospecting and automating internal routing, the system preserves the agency's most valuable resource, the lead agent's time. This bandwidth allows for high-leverage engagement. The agent can personally call over 1,000 clients to conduct quarterly and annual financial reviews. This capacity is what allows the agency to chase aggressive targets, such as writing 50 life insurance policies in a single year. Life insurance serves as a strategic gateway. A direct conversation about coverage naturally uncovers deeper needs for mortgage refinancing or equity lines. It also creates the space for honest advisory. When an internal product isn't the best fit, the agent directs the client to a preferred partner, prioritizing long-term trust over a single transaction. The automated, compliance-heavy backend exists to clear the path for this moment, ensuring that when a call finally happens, it is focused on human advisory rather than administrative triage. Compare this model against the standard transactional approach, where mortgage and insurance providers lose contact with a client immediately after the sale. In a market defined by interest rate volatility and rising premiums, firms that rely on a single transaction face massive client churn. By combining automated CRM triggers with proactive personal touch, the agency builds a defensive barrier around its client base. This closed-loop system captures recurring revenue through refinancing and equity products, even when initial purchase volumes decline. This is the Lenders for Life model. It provides a structural competitive advantage that larger, impersonal corporate providers cannot replicate. The operational shift required to scale through massive acquisitions is clear. You must automate the periphery of the business, not the core. Utilizing AI in financial services requires a strict compliance air gap to keep operational logic separated from client data. True growth requires both components to work in unison, locked into perfect stability by a rigorous structural design. High-volume growth targets are reached by keeping technology in its optimal lane, processing the raw data so the team can focus on conversion. Scaling in a regulated market relies on automated systems to tee up the opportunity, but it depends entirely on trusted human advisory to close the loop.